Over the past few months, many companies have seen their profits decline substantially. As a result, many dividends have been cut. And I know that many of you guys are looking for long-term passive income stocks. So today I'm going to share one low-risk stock that I think is a very special dividend stock for people who value safety over anything else. And this stock is actually one of the better deals in the market right now. The stock that I'm talking about today is Tyson Foods. They sell products like fresh chicken, frozen chicken, and chicken nugget. Also, make sure to smash the like button and keep this chicken nugget happy. Instead of starting out with the payout ratio and dividend yield, we're gonna start off with analyzing the actual business and valuation, because those factors separate the good dividend stocks from the amazing dividend stocks. So what makes this business strong and what makes this valuation a good valuation to buy the stock? First off, they have tons of free cash flow. Free cash flow just represents the net amount of cash that comes into the business. It is very similar to profit. When you divide their free cash flow of about $1.6 billion by their $21 billion market capitalization, you get a magic number of 0.07 or 7%. If you're buying the entire business for $21 billion, you would be getting a 7% return on your investment, assuming that they maintain their current levels of profitability, which is very reasonable. A 7% free cash flow to market capitalization ratio is very high for many dividend stocks. I bet many of your dividend stocks only have a free cash flow to market capitalization ratio of about a couple percent. So 7% indicates that the business is generating a lot of cash relative to its valuation, which is a good sign that the business is undervalued. They also have one of the safest businesses in the world, which is 10 times more important than a low payout ratio. Chicken and chicken nuggets are always going to have a steady demand by consumers, and it's very hard for many businesses to compete with Tyson Foods because many consumers are in habit of eating the same chicken, the same Tyson chicken every day or every week, and a competitor can't really develop a better version of chicken because it's a standardized product, which also makes it 10 times harder for them to compete against Tyson Foods. It makes this business very durable against the competition, so it's very unlikely that this company is going to see their profits decline very much at all in the future, and it also makes it very unlikely that there will ever be a dividend cut with this stock. But the situation is not super perfect. During 2019, they took on $4 billion in debt, and they paid back $3 billion in debt, so that means they took on a net $1 billion in debt during 2019, bringing the total of long-term debt to $9 billion, which is simply too much for this company. That's just too much debt. If they ever needed to pay down their debt, it would take them so long to actually pay it off because they don't generate enough free cash flow or cash to actually tackle that amount of debt, which is a very big red flag. However, since this is a very stable business, I don't think it's going to be a problem for their dividend, but it is not a great situation to be in. But let's get into the specifics about their dividend. They have a high dividend yield of 2.7%, and they only have a payout ratio of 36%. So there's room for tons of dividend growth. And in fact, over the past 5 years, they've been growing their dividend by over 30% per year, which is phenomenal. So you can't really complain about this dividend. You're getting a high yield, high dividend growth, and a low payout ratio, which makes it seem like a good stock. And given that they're expected to make about $4.50 in EPS this year versus $5.40 last year, they're not seeing huge earnings declines, which means that they can sustain a fairly fast rate of dividend growth during these times. They're also expected to have $6 in EPS next year, so they're expected to have very high levels of EPS growth in the future, which means that they can really sustain high levels of dividend growth for a couple years. And they've been paying a dividend for more years than I have been alive, and they've been growing their dividend for the past 8 years. So there's no question about their dividend's quality. The only red flag I see with this stock is their debt. But other than that, I hope you like this video. Make sure to drop a like and subscribe down below. It really helps out a lot.